There is one number the entire life insurance industry repeats: by 10 times your income. It is a fine place to start and a terrible place to stop. Because your real number is not a multiple of your salary. It is the size of the hole your income would leave behind. Today we build that number from the ground up. Meet James. He is 38, married with 2 young kids, earns $72,000 a year, owes $250,000 on the house, and has $40,000 in savings. If his paycheck vanished tomorrow, how big a check would keep his family whole? Let us find his actual number, not a guess. One quick disclaimer: this is decision math, not financial or insurance advice, and your figures vary by health, age, state, and year. Talk to a licensed agent before you buy. Start with the problem. About 4 in 10 adults say they do not have enough life insurance, and roughly half of those who own a policy have never checked whether the amount still fits their life. Most people either guess or they let a workplace form pick the number for them. Both are how families end up underinsured without ever knowing it. Your job's free life insurance is usually 1 to 2 times your salary. It sounds like coverage. For a family with a mortgage and kids, it is a rounding error, and it disappears the day you change jobs. There's a clean framework for this, and it spells DIME: debt, everything you owe, plus final expenses. Income, the paycheck your family would lose, and for how many years. Mortgage, the balance that keeps the roof over their heads. Education, what the kids' schooling will cost. Add those 4, subtract what you already have, and you're looking at your real coverage target. And as always, here's where this comes from. Now, build James's number, 1 letter at a time. Start with the letter D, debt. He has about $27,000 in car loans and credit cards, and a funeral runs around $8,000 today. Call it $35,000 your family should not have to cover out of grief. Next up, the letter I, income. And this is the big one. James wants to replace his income until the kids are grown and on their own, about 10 years. 10 years of $72,000 is $720,000. This single line is why 10 times income exists as a shortcut. But notice we are pricing the years his family actually needs, not a round multiple. Now the letter M, mortgage. $250,000 left on the house. Paying it off means his family keeps their home no matter what happens to his paycheck. That alone can be the difference between grieving in place and selling under pressure. And the letter E, education. 2 kids. An in-state public college runs a little over $28,000 a year all in, so a conservative college fund is around $100,000 for the pair. Private schools push that far higher, but we will keep James's number grounded. So add it up. Debts and final expenses, $35,000. Income replacement, $720,000. Mortgage payoff, $250,000. Education, $100,000. Now subtract the $40,000 James already has saved. His real target lands right around $1,065,000, not a multiple of his salary, the actual hole his income would leave behind. Here is the gut punch. James's employer policy pays out about $150,000. His real need is closer to $1 million. The plan he thought had him covered fills roughly 1/7 of the hole. That is the whole reason we run the number instead of trusting a form. Quick pause. If you are still here and this is actually helping you think it through, hit subscribe. No fluff, no fear selling, just the math. It genuinely keeps this channel going. Okay, back to it. Before we price it, 3 mistakes that wreck the number. 1. Counting only your employer policy. We just saw why. 2. Forgetting a stay-at-home parent. Replacing the child care, cooking, and driving they provide runs tens of thousands a year. So that parent needs coverage too, even with no paycheck. 3, and this one is right. Buy a term long enough to cover the years the kids actually depend on you. Sourced, like every number here. Now the part that surprises everyone. $1 million of 20-year term for a healthy 35-year-old costs roughly $40 to $60 a month. Most people guess it is 3 times that. In one industry survey, people overestimated the cost of term life by about 3-fold, which is a big reason they never buy it. James can close an 86% gap for about the price of 1 dinner out a month. So here is the honest verdict. Do not buy a multiple of your salary. Run your dime number, debt, income, mortgage, education, minus what you have. Then buy level term long enough to cover the years your family depends on you and size it to that number. For James, about $1 million of 20-year term, near $50 a month, closes the entire gap. The math is simple. Most people just never do it. That is your number. But here is the deeper question most people skip. Do you even need life insurance at all? The next video breaks down exactly who can safely skip it and who absolutely cannot. It is right here. Thanks for watching, and if this earned it, subscribe. See you in the next one.